Long story short, I came to the conclusion that it's crap.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. My guest today is David Collum. David is among the most provocative voices in finance, and provocative in a way that you can really only be as an outsider, which works because he is an outsider. His day job is a professor of chemistry at Cornell University. But through his research and writing about economics, he's developed a following in economics, finance, and investing. He writes an annual year-end review, which is hysterically funny and poignant. Highly recommend it. We're going to talk contrarianism, market valuations, the Fed, the election, and more. Please welcome David Collum to the podcast.
Hey, glad to be here. This year's going to be tough to be funny about, but yeah.
It's a little glim, and here today, I'm in Michigan, and it's a little cloudy, which, really fits the mood of the country. For our listeners that might not be familiar with your work, how is it that a chemistry professor becomes almost a household name in the field of finance? What was that trajectory like?
Well, it's weird, actually. This week, for example, I've gotten emails and phone calls from people that sometime back I couldn't have fathomed chatting with. So, for example, I've already spoken this week to 2 out of 3 Reagan's economic advisors. And I'm sitting there somewhat dumbstruck. I'm scheduled to have a Zoom meeting with one of them and a political pundit tomorrow to chat about something that I think is going to go super dark. There's no way to rationalize how I got there. I'm just a synthetic organic chemist. But I started studying markets in the mid-90s when I was a boomer and thought I was going to get rich buying tech stocks. And then I miraculously exited tech stocks in 99 and bought gold. Through the next decade, when the world was getting crushed, I had the best decade ever. And then from 2009 up, I completely missed the equity rally. Now, I also think that there's a decent chance that the markets are going to give almost all that equity rally back. Believe it or not, there's people who think, oh, no, you can't give back 450%. I actually think you can. And I just finished writing a section last night, a rough draft, and Amazon went up 1,000% over a fairly small window. If they gave the entire 1,000% back, they'd have a PE ratio of 15. That's a pretty weird market, right? That's a pretty strange world. And, they just put Salesforce.com into the Dow, and Salesforce.com looks like one of these companies that you say, in 10 years, it might be gone. And now it's in the Dow. I have no idea what they just did. They took out Exxon. They took out Pfizer. They put in Salesforce.com. I had to Google it to find out what they did. So the markets are nuts.
So that is most definitely a contrarian position. And, when you think about contrarianism versus conformist views, it's really interesting in the markets because there's a whole school of thought, which is trend following, which is, we're just going to, turn off our brains, buy when the price is going up, sell when it's going down, keep it simple, stupid. And, I don't care what the valuation is. I don't care what Amazon's PE is. It means nothing to me. I don't care that, Salesforce is a cloud-based service versus, a tangible Pfizer or Exxon that's actually creating something. It doesn't mean anything. All that matters is the direction of the price. And there's a whole school of thought that invests that way. And then you have, it's amazing to think that, oh, wait, what is the intrinsic value? What is the actual valuation of a company is now a contrarian position, but it is. What is the real value of what you're buying? What is the value of a share of stock, a slice of a company that's out there? When it comes to the market, contrarianism is not always rewarded. And everyone wants to be Michael Burry in The Big Short. Everyone wants to, see it before everyone else and get in and be there to profit. But the timing is as important as the call. And if you're too early, you're out. So how do you handle as an investor? How do you think about contrarianism versus, conformity in that context?
Well, I don't buy anything thinking that the next year or two is going to make or break me. So I was buying gold from 290 down to 270, and eventually I had to stop because it was painful. The NASDAQ was soaring and my gold was tanking. I picked up buying again at 300 when I was no longer underwater, bought it up to about 450. But that was contrarianism because no one thought gold made any sense whatsoever. Over the 20 years that I owned it, it actually beat the S&P by 2% annualized. I believe what you have to do, if you're not going to be a momentum investor, is you have to really convince yourself that you're right. You have to work at it until you do. So one of the other great places, not in terms of total sort of amassed wealth, although it worked pretty damn well, I bought the tobacco stocks when that big lawsuit was looming over their heads. And I stared at it and I'm going, what am I missing? The dividends are huge. The PEs are in the basement. Everyone hates them. They're morally unsound. That's up my alley. And I'm going, but they got the lawsuit. What am I missing here? And then one day I read an article that said if they lose the lawsuit, they'll have to raise cigarettes 50 cents a pack. And I go, it's just a tax. And so I bought a bunch and put a couple kids through college. And so I think you have to marry an investment. I don't think you can buy an investment. I don't think you can buy into something if you're a serious buyer and not think I'm now going to knock. This is like getting married, right? You got to say I'm in it, right? This comes hell or high water unless something fundamentally changes. I got to white knuckle this thing because I'll get out. One time I bought into China and I bought into Europe and I bailed because my heart wasn't in it. My heart wasn't in it. If I had bought Bitcoin, I don't want to go there, but if I'd bought Bitcoin, I first came on my radar at about 10, I would have sold it at 40. So I don't regret not buying Bitcoin because I would have been the guy who sold it at 40. Guaranteed.
It's amazing that in tobacco, the legal regulatory environment provided you a buying opportunity. You look now at the FANG stocks and the runaway valuations, but you also look at the antitrust risk and you look at the risk. I mean, there are so many risks on a legal regulatory standpoint, and those stocks are priced so high, there is so much room to fall that you would think the market would price in those risks, but they're not. They're not at all. Maybe it's a short opportunity here. I don't know. What do you suppose is going to be the catalyst that's going to turn it around?
If you look, for example, at the European banks, they've been destroyed. Their capital gains have been unwound back to 1987 pricing in a nominal sense, not even inflation adjusted. I think, again, I'm not a bank analyst, nor do I pretend to be one on the internet, but I think it's because the screwball central bank policies driving interest rates to stupid levels is basically destroying the banking business model. And I think they're hurting the banks badly to save them, right? This is where it's like chemotherapy or something, right? They're bringing them to the edge of death to save them. I'm not convinced they'll succeed. I brought up in a conversation with a hedge fund manager who shall remain nameless, but there's not a single listener on your podcast who doesn't know his name. So if you were to say, name me big three, he's one of three that everyone would name. And I brought up energy, which I've gotten told by many people I've looked at, and they say it's the cheapest it's been and blah, 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 ever, that sort of thing. And I said to him, what about energy? And he was not very high on it. I said, well, what if I bought the big caps? Would I be okay in 10 years? He goes, I don't know. And that gave me pause, right? If I give him a 10-year window and he says, I don't know, not just I don't know, like I don't have a clue, but I don't know, like I have doubt. And then he said, if you want dividends, buy the tobacco. And I go, well, I own those, but I get it. But they've got all the vapes, right? The tobacco guys ran into the vapes. I'm going, Jesus Christ, you guys. I know why they did it. I mean, they thought vaping was going to knock out tobacco. So it was an aggressive move to save their business model. But now they've got a lot of debt. They bought vape companies for too much money. And so the question is the dividend secure? The dividends are big. Would you rather have a tobacco stock paying 5 or 6%, or would you rather have a 10-year treasury?
The growing consensus in the market, certainly by financial advisors and, just really the mainstream school of thought, is that the Fed has the ability to manage the markets indefinitely. They can, like I can control through my thermostat, I can control the temperature of my house. The Fed can control the markets and keep volatility down forever. And, I think the people who are fans of Keynesian economics and fans of the Fed are emboldened by the recovery of the global financial crisis and by the last few years, where it seems like anytime we have a 3-4% dip and all of a sudden here comes Jay Powell to the rescue and all is right in the world. A little QE here and there, rates are at zero. They're not going up anytime soon. What do you say to people that are, not only looking back on, the markets have in fact been able to survive thanks to the Fed policies, but like I said, emboldened by that fact and, really completely disrespectful of the risks to investing and the risk in the market because they feel like the Fed has, provided a safety net?
Well, yeah, I have a very clear vision on that. I think that those people are going to get burned. And I'm rereading Devil Take the Hindmost. It's like, shakers shaken so they lose their carnal thoughts. Rereading Devil Take the Hindmost. And there was this one line in it that I had long since forgotten, but they said that every major bubble had an implicit or overt sovereign backing, whether it's having people on the board of the company that are prominent sovereign people, so that they have a sort of an air of credibility. And we have the Federal Reserve in this bubble. Now, every bubble has a story, whether it's, the tulips or the South Seas Company or whatever. And they're very good. And so the dot-com was a very good story. It felt so transformational. And what actually started to get my attention is I started doing the math on a company like eBay, which is the only dot-com I thought of buying. And I did the math and said, if eBay grows its earnings 20% a year for the next 12 years, they'll be at fair value. And I can't buy that crap. And so I couldn't do it. I just couldn't get myself to pull the trigger. And I'm not a momentum guy. But the dot-com story was beautiful. It was a great narrative. And then, and so what's the story now? The story now is the economy sucks. We've getting hit by a pandemic, but I didn't even count that into my analysis. The pandemic, I think it's destroyed our economy at some level. But the story is that the Fed has our back, and we have no alternative. The TINA model. There is no alternative. And I think that story will be shown to be completely and utterly flawed. And the problem is the markets are so highly valued, and you're being lied to about it, by the way. The triple Qs, for example, if you look up the PE, you see something in the 20s. If you take the entire PE and make it into a big multinational conglomerate, and you take the loss and the earnings, combine them, and come up with a price-earnings ratio for the entire triple Q, it's in the mid-90s. And you go, how do you get to that? Well, it turns out that in the prospectus of the triple Qs, you can see how they calculate, and they do a lot of funny stuff. So if you're buying equities that are currently priced for a 1% return, it's like buying a Toyota Tercel for $200,000. What's going to happen at trade-in? In a trade-in, you're going to get killed. Maybe there's a guy out there who will trade it in for $140,000, but I don't think so. So you can't be buying this stuff. And as Hussman would say, if they manage to elevate these equities and these bonds at these prices, the stocks are priced to earn almost nothing. The bonds are priced to earn precisely nothing. So we're either going to have a tremendous period of stagnant returns, or we're going to get our asses kicked, and then we'll be offered an opportunity to buy under normal circumstances again. But it'll take some balls because it'll be a contrarian move.
Yeah, and in a market where the Fed will step in and purchase stocks, which, they claim they haven't done, but the market's down 20, 25%, I think they come in.
Well, I don't think they do. I think they have, I'm guessing they have proxy buyers. The Swiss National Bank, someone should have told me this. I found this out too late. I didn't understand the Swiss National Bank. Their business model is you can own their shares, they can print money, and buy tech stocks. If I had known that 10 years ago, boy, I would have been all in on Swiss National Bank shares. Now they're loaded with fangs. I don't want to go there, even though they can still print money. But that's the strength. So I think during, for example, the March crash, I think the S&B was buying fangs by the boatload. And I think there were phone calls between the Fed, and they're jamming down rates, and they're pumping, they're buying corporate junk bonds. Corporate junk bonds. What kind of crazy capitalism is that? The Swiss National Bank's buying fangs, and so they put in a bottom. But that's a model that's so far from capitalism, so far from wealth creation, so far from the wealth of nations that Adam Smith talked about. I don't believe it.
It is unbelievable. And they were buying corporate junk bonds. They were also buying corporate bonds from the likes of Apple and Volvo. And companies, Berkshire Hathaway, they bought Berkshire Hathaway bonds. And when you talk about buying fangs, it may or may not be that they were buying them directly. It could just be that they were buying market cap weighted indexing, because right now the top 5 stocks in the S&P make up 22% of the entire index. So there's a huge amount of concentration. And if you want to support the large cap US equity market, you can do so by buying essentially, you could buy market cap weighted indexing, which is so heavily concentrated. You're essentially doing the same thing. You're holding the whole thing up from the top few. But meanwhile, as you alluded to, during the pandemic, your local dry cleaner and your local gym and your mom and pop restaurant that's a family owned business, if they're not out of business, they're close and they're nervous and they've been
they're
hurting.
They're dying. So again, a conversation with a guy who I think might be considered the world's most prominent currency trader, and that'll tell some of your listeners possibly who was talking to. I asked him, I said, am I correct that despite the fact that it feels like a lull, are we in the eye of a hurricane, and has the global economy really been pounded? And he said, absolutely. So I think right now there's the calm, and we came out of our basement and it's calm, and you look around and there's clouds and nothing's flying around, but the other half of the hurricane is going to go overhead. And, we're not ready for it. There is no restaurant in the world probably that can stay alive at one-fourth occupancy, except for ones with drive-through windows.
So let's walk it through, right? And let's try to figure out what the catalyst could be for a change in direction of the equity markets. Because right now you've got, the majority of assets that are coming into the market are doing so at market cap weighting. They're not price setting. They're just coming in at cap weight. You've got liquidity provided by algorithms, which are Delta One arb traders, which are just, arbing between derivatives and the equity market. That's a fleeting liquidity. That's the illusion of liquidity, but they're not going to stand in. There's nobody saying, well, I'm going to, if Amazon drops by $10, I'm coming in and making a market. But no, they're all just there right now, pricing based on other derivative markets. And potentially you've got MMT coming on the horizon, depending on, again, the election results and what might be. But it could very well be. So you've got this unsustainable level of debt on the country. You've got, the Fed balance sheet. I mean, it's just like play it out to its logical conclusion. You've got all these different trends that are moving in, this direction where it feels very secure and it feels like it's just a continuation of a trend and things are just going to keep going. But these things cannot go forever. So what could be the catalyst? What should people be prepared for as, a warning sign that, hey, things are about to turn and they're about to turn quick?
Well, first and foremost, the 5 to 8 stocks that are loosely called the FANGs, but you can put in NVIDIA where Netflix was, and you can put in Tesla if you wish, just for fun and stuff like that. Their valuations are outlandish. They're absolutely. I just wrote a rough draft of something last night, and I went through all the FANGs. I went through Nikola and all those companies. They're completely outlandish. There's just nothing left to be had there except for more froth. And so once you're overvalued, there is no way out collectively. So a trader can get in and out, but collectively the market you're on top of a high wire and you have no way off it. And so you can either take literally decades to burn it off while the GDP slowly catches up, or you fall to the earth, or you do a combination of clock burn and fall to the earth. Take 20 years while the markets kind of go down, and 20 years while the GDP kind of grows, and then eventually you get back to fair value. But it's like someone who's hopelessly in debt, right? There's no way to get out of it. You could default, but that's what the sort of the market crash is. It's kind of a default, right? So I'm sanguine about not owning stocks at this point. By the way, they weren't even cheap in 2009. That's the absurd part. If you I looked at 20 valuations back in 2018, 20 metrics. They all showed that they were about fair value at the bottom. They were a little below fair value, but they were not dirt cheap. They had not washed out. There was nothing washed out. The fact that they had hurtled to the earth from stupid levels makes it feel like they washed out, but they didn't get cheap.
Well, that's the thing. In a free market, stocks will fall to a price at which somebody will buy them for the intrinsic value of the company. I can buy the machines in the company. I could buy the contracts. I could buy, there's an intrinsic value that something's worth. And when you allow stocks to fall to that level, then value investing becomes a phenomenal thing. I can do some real research and say, hey, here's a company that's worth more than it's trading at, and you can turn a quick profit there. But when you don't allow the stocks to find those levels, the levels at which people want to buy them, not to trade them, not because historically stocks have done X or Y, but because you want to own the actual company that you're purchasing at the price you're purchasing at. What a novel concept. Then all of a sudden, all these fears become assuaged. Then everyone can feel comfortable. You're investing in something for the long term for the right reasons, but we will not, our policymakers will not allow the stocks to find those levels. They won't. So it becomes an issue. The Fed has solved the crisis of the 4% decline in the fourth quarter of 2018. Hooray, congratulations, right? But they haven't solved anything over the long term. And now we've got a mark-to-market market, which is as fickle as, as anything in the world. I mean, it could immediately turn around the next day. And then you've got the same problem all over yourself. All that's left is the balance sheet of the Fed, right?
Well, so here's the paradoxical thing. So I was looking at Netflix, which is 100-fold gainer over a pretty short period of time, not 5 years, but pretty short. But their content is costing them billions of dollars a year. Their business model is they have to create new shows every year. And this is not like you're building up some legacy wealth, because the content you have to keep pedaling as fast as you can. And so next year they'll have to build content too, and the following year they'll have to build content. So this multi-billion-dollar pump has got to keep going. You can't take your foot off that gas. So the question, so let's say Netflix gave back its 100-fold gain and reversed it by 50-fold. So over the last 10 or 15 years, whatever it was, it's now 2-fold gain. Now you own shares that are 50 times cheaper, but they still don't make money. How do you think about that? I don't even know how to get my brain around that idea. So they're still a losing company at 50-fold cheaper price. They're 2% of what they are today. Drop to 2%, they're still losing money.
It's just unbelievable, right? I mean, the classic thing is, what is business? Buy for $1, sell for $2. That's it. Simple as that, right? And these guys are buying content for $2, selling for $1. And you're right, they are only as valuable as their most recent content that people are willing to pay for, besides some legacy users that might be slow to cancel when the content dries up. But, there's no loyalty there. I'm not going to feel bad about canceling Netflix because they gave me great content for 5 years and now there's nothing to watch anymore. I don't care. I'm just going to the best service. So
Amazon Prime, right?
Absolutely.
And then you look at something like Tesla. Tesla right now, you're paying something like, and this is vague, but I wrote about it last night, but it's still vague because the numbers are so crazy. Tesla, you're paying something like $2 million for every $80 of sales. Tesla's only profitable because it sells carbon credits that it's given to by the feds, right? Tesla gets handed carbon credits for driving a car. They say, well, you can drive 250 miles per hour and go 300 miles on one charge. You go, that's really cool. How far can you go on a gallon of gas? And the answer is nowhere. And so I'm not impressed by that. And there's no road I can go 250 miles per hour on. And by the way, which would you rather drive, a Tesla or a 1945 Jaguar that can do 120 miles per hour? So explain to me how the Tesla is really that much better than a mid-40s Jaguar. And tell me we've really created wealth. Now, for those who like to be green, and I know it's cool, the Tesla's silent. I'm told it's really a rather weird experience. But then the question is, which would you rather do? Drive a Tesla or have sex? One's free or $20 on a bad day, and the other's not. The other you have to pay a fortune for. So, why is Tesla? Tesla has something like some tiny fraction of the cars sold in America by the American and European entire auto sectors. Tiny fraction, like 5% maybe. And their market cap is larger than the combined US and European auto sector combined. So Tesla, I saw a plot once of Tesla share price superimposed upon the South Seas bubble, and the South Seas bubble cracks and Tesla just kept going. And so at some point, and Elon Musk is obviously a shyster, right? I mean, he's obviously P.T. Barnum. He's all, let's get some ventilators. Let's get a submarine to save kids from a Thai cave. Let's smoke pot with Joe Rogan, right? He has a rocket company. So what? He talks about mining the moon. That's stupid. He should stop smoking pot. And so his baffling with bullshit story should scare the crap out of people who are owning shares in a company with a $600 billion market cap. but they like it because it's been so good. They're up something like, I don't know, 800% since March.
And they're emboldened. They're emboldened by the market, and they're emboldened by the price moves. I mean, like you said, Tesla right now is a market cap 10 times forward with 1/10 of the sales. That's a 100 times spread there. And the assumption that they're going to, dominate in the, in the electric battery technology market, and they're going to dominate in the, autonomous taxi fleet market. And those are possibilities, I suppose, but they're priced in. The stock is priced at a level where that is a baseline expectation now going forward. So
by the time they get there, their IP is going to be going off patent. That's the other problem, right? So they have cool tech. They're going to lose that. I have a friend at Caltech who's working on sodium batteries. What's going to happen if sodium batteries win? Tesla can you can die at that point. There's just no way that, Tesla could be the hottest car company in the 1920s. There were 250 others. You're really going to bet that one's going to win? I'm not. He's not Steve Jobs, right? You read Steve Jobs' biography. Elon Musk is not Steve Jobs. Jobs could see the future. Elon Musk. There's a great quote from Henry Ford that says, "Vision without execution is fiction."
So what do you do, right? Because you can't short Tesla. If you're going to do it here, you would have done it already, and if you did it already, you've been squeezed out. So what do you do? You're worried about inflation. You're worried about the Fed. You don't like the valuations of the equity markets. Where do you put your money?
Well, so the Fed's wall, the wall that's going to stop the Feds and going to stop the MMT and stuff like that's going to be inflation.
And if we lose the dollar, then inflation runs through the roof.
Right. And if MMT shows up, 22% of the dollars ever created were created this year. We're nuts. We're out of our minds.
I'm sorry, 22% of the dollars that are currently in circulation
created this year.
Unbelievable.
And so, there's a thing called the Chapwood Index, which was obscure as hell until last year. And then more and more people, it went pretty viral, I would say. But the Chapwood Index, you can Google it. It's an inflation index, very simple, very straightforward how they measure it. So if you want to know how do you do it, there's 500 items that are monitored in the 50 biggest cities in the U.S. The Chapwood Index is registering about 10% a year for 10 years, 5 years. And so it's worth the peak. And it doesn't appear to be chicanery or anything. And I think a lot of it's real estate. So you go to some place like San Francisco. By the way, it's about to dive because one of the things that's happening is there's a massive real estate exodus from the cities. The condos are going on the block and houses in the bedroom communities like Greenwich, Connecticut. What I was told was in one of these guys' neighborhoods in Greenwich, there used to be 10 houses in that mega buck category for sale. And he says, now when a house hits the market, there are 30 bidders.
Well, I mean, forget about commercial real estate in the cities. I mean, forget about that. That's a blip compared to commercial. Did I say commercial? Forget about residential real estate in the cities. That's a blip compared to commercial real estate, which has, by the way, while the market's just trucking along and everyone's talking about how great the economy is and the economy bounced back, we have lost the entire...
no way the economy bounced back. I don't know how they're faking it, but there's no way. And one of the companies, was it Microsoft? One of the big techs, name recognition techs, basically told all their employees, plan on working from home from here on. They don't want the cost of housing all these employees in cubicles. And when in the future is some big company going to fly 25 execs to a big meeting in New York City? Never. I don't even know if chemistry at Cornell is going to have on-site interviews again, on-site seminars. I think the new system's going to be, hey, so-and-so is going to be here at 4:00. Anyone interested? Here's the Zoom link. I think we're going to Zoom all the seminars because it takes the person 1 hour instead of flying in the day before and flying out the day after, 2 hotel rooms, airfare. We're going to say, oh, how about a free Zoom? Why not? Or, the chemists will say, I'll tell you what, upload your seminar on YouTube and anyone can go watch it anytime. So I don't see the airline industry is not coming back. I got a counter argument on that. Said, yeah, but it's being offset by retail wanting to fly all over the place. I go, you can't replace commercial flights with retail flights. That's for one thing. Retail was flying before too, and they're going to get bored with flying all over the place. I know they've been cooped up, so they want to get out, but they're not going to hold up an airline industry.
Right, and they're more price sensitive, and you gotta
yes.
So okay, so I got a couple questions that I want to get to, but just on this real quick. So we've talked about equities. We haven't talked about the horror show of corporate fixed income, but let's put that aside. And I know you don't want to go there. Real estate is shaky as could be. So where do you put your money if you want to protect it from inflation? Besides gold, is there another place where you think it's a safe haven or even an opportunistic investment to protect yourself from inflation?
No. I have. The goal to save me. So from, again, 2000 to 2009, I was heavily into gold and energy. I got sort of booted out of the energy beyond the top, gave back a chunk of it, but not all of it, and then didn't go back in. I'm looking at energy. I as much as I was warned off it, I think at some point, my idea of technical analysis is that when a sector quits hurtling to the earth, maybe I'll buy it. That's about as sophisticated as I got.
Yeah, but if you're looking at energy, you have to take into account the fact that if we have a Biden-Harris or Harris administration, that the Paris Accord is likely, and then all of a sudden, you're talking about incentives and a whole different rule set, a whole different game plan here, and a whole different framework.
What are they going to do?
Value.
Give me the worst case. Give me something tangible.
Well, let's say they put tariffs on fracking, for example.
They'll pass it off to us.
Yeah, I suppose. I mean,
right.
In that scenario, would not wind and solar be a good place to go?
No. So 2 years ago, I sort of blew a shot across the bow when I was writing. I wrote about climate change. I said, look, if it got into my head, I believe anthropogenic global climate change is real. But I also said that I was that I was agnostic, really, because I hadn't spent the incredible months of time required to formulate a good opinion. I actually told the Secretary of Energy that, and he kind of blew a snot bubble. I said, no, it would take thousands of hours to be able to state something with confidence. And he said, okay, I understand that. And I said, what I was astonished by was how many of my brethren in the sciences signed off on climate change just by basically saying, follow the science, which this year is kind of a mixed buzzword, right? And I was stunned by that. I said, these people have done no homework, yet they're saying, yeah, it's real because I haven't been told by my friends it's real. So then I challenged them. I said, look, the consensus among the scientific community is flawed. It is not. Very, very few of the scientists who say they believe in global warming actually have their heads pulled out of their asses. They don't know. There are some who do. Now, so I was baited by colleagues who said, look, you got a big podium. You got a big audience here. You owe it to people to dig in and get the answers to these questions. So last year I spent unbelievable amounts of time reading about climate change. Long story short, I came to the conclusion that it's crap. The first thing when you dig into it, and if you want to read this, go to what's called my 2019 year in review. There's about 30 pages on it. And I go through all the different facets of climate change. And the first thing you find is the first lie is that you will be told that no one with a half a brain in the sciences doesn't believe it. And then within 30 minutes of digging, you can find 24 physicists from the most elite schools in the country who say it's total crap. You can find chairman of Hebrew University who's a solar physicist saying there's not one shred of evidence that CO2 is causing any temperature change. You'll find, former White House, whatever advisor saying that CO2 isn't doing squat. You'll find the former head of the National Academy of Sciences saying it's the biggest hoax in history. So the story that only idiots sign off on climate denial is a lie. It's a profound lie. Then you start digging into the stories. What you find is that you say, okay, so who's being paid by oil? And the answer is nobody. There's a few think tanks, that are getting some money, I'm sure. But the old white guys all say, I'm not getting a penny. I'm just telling you this because I'm not long for this world and someone's got to speak up. Nobel Prize winners saying, I got to speak up. So then you start digging into the facts, and what you find is the conflict is a $1 trillion a year climate industrial complex. You add up all the departments, all the companies that sell solar panels and wind farms and carbon credits and all that, $1 trillion a year industry that if climate change turns out to be a dud, they go away. So what are the odds they're going to find climate change is a dud? You find cancel culture in there. You break from the narrative, you get kicked out of the hive. And you get kicked out of the hive viciously. So serious climate change guys who've said, look, I'm not buying the story now, they get beaten to a pulp. So it's just like the cancel culture in every other field. So I spent a ton. I wrote about 30 pages on it. And I came to the conclusion that within an error bar, it looks like total crap. Now, here's the question I'll ask your listeners who maybe don't believe me. The question I'm going to ask them is 100 years from now, assuming climate change is real, what's the worst possible thing that you can envision? What is it? Name it. Tell me. Are we going to be lit on fire? What's going to happen? And usually there's some statement about the coast, about the sea level, but the houses all washing out into the sea. And I go, okay, that coastline, how many of those houses were there 100 years ago? None of them were there 100 years ago. They don't we depreciate stuff in 25 years. So the coastline can move all over the place. We'll just build, we'll put up better foundations. We'll do whatever we got to do. Not a big deal. My wife's a biologist. She can talk about the biological effects, and I'm sympathetic to those.
Yeah, look, early in my career, I worked on a carbon credit fund, and I got really into this world. I was really young, and I remember I went to a conference, and we're out for drinks, and there was a guy there who was, had a couple drinks and was speaking freely, and he came to the conference with a business plan that was, he wants to take a power plant in Spain, and for $40 million, he can take the entire power plant, pack it up, put it on a barge, and rebuild it in Nigeria. And for $40 million, he could basically move the same power plant from Spain to Nigeria and come away with $80 million in carbon credits. So he was looking for $40 million. He's like, I can give you a 3x return in 6 months. And, you think about it, it's the same power plant, right, with the same emissions. It's totally just gaming the system. That's all it was. And I, exited that industry at that moment.
It's towing icebergs for their water, right? It's just stupid.
I know that you've been writing about wealth creation recently, and I wanted to get your thoughts and maybe get a preview of what's coming in your 2020 year in review.
Well, so I've been thinking about wealth creation for a number of years, sort of wealth of nation level wealth creation. And then I read a book by Robert Gordon, which inspired me. I said, okay, I'm going to write about it this year. And Gordon makes the case from 1870 to 1940, we had an unprecedented and non-reproducible wealth creation. And then from 1940 to 1970, it tailed off pretty good. And from 1970 to the present, it's flattened pretty badly. With a spike in 95 to 2005 from the computers, but that's over. So here's an assertion. Amazon is not a pioneering company. And people say, how can you possibly say that? And I'll say, because Amazon is just a moderately faster version of the Sears Roebuck catalog. The Sears Roebuck catalog came along, and you could be out on the prairie and you could order a prefab house. You could order any appliance that was available at the time. Whereas before, all you could do is buy from the country store out of barrels of flour. And the Sears Roebuck catalog gave you access to everything. So Amazon is a Sears Roebuck catalog with admittedly more crap and admittedly faster delivery, but it's not transformational. The Sears Roebuck catalog was transformational. Wilbur Wright, I think it was Wilbur, who invented the airplane, lived to see jets. That's transformational. And there's subsidiary inventions. Electricity, what a profound thing, right? To bring electricity to the world. It was invented years back or discovered, but the subsidiary inventions, which are really secondary inventions, the household appliances and stuff, were so profound. We got nothing like that. We've got 140 characters on Twitter, right? That's what we got. And so you can really make the case that we are what we're doing now. Facebook, I cannot identify wealth created by Facebook. I cannot, Netflix, right? You can get almost anything you want. Here's the deal, though. You can only watch one thing. You can only watch one thing. So you got a bigger choice, but you still can only watch one thing. And, when I had 3 channels at home, there was always something worth watching. Might be Mr. Ed or something, but it wasn't transformational. A TV was transformational. You could see stuff you couldn't see. Netflix is not transformational. I would say computing is transformational, but that was, again, a burst for about 10 years. And so I'm going to go through that idea of, scraping data, Google, Facebook, that's not transformational. There's no wealth created there. You can scrape my ass all you want, but I'm still only going to buy one mattress. And maybe you can get me to buy Sattva's because they paid you more than Tempur-Pedic paid you. And so they'll shove a Sattva at me, but I'm still just going to buy a mattress. And if I didn't buy it there, I'd buy it from the local store. And so there's no wealth creation. It's just cannibalism. And to the extent maybe they're so smart, they can figure out what's the best mattress for me, I benefit a little. But it's really just cannibalizing marketing dollars. And I think at some point, companies are going to say our marketing budget's too high. We're spending way too much paying Facebook and Google and these guys for scraping data. And then the question, well, I think some of their revenue stream, and we're never going to know this, but I have this suspicion, some of their revenue streams coming right through Department of Defense coffers. So I think that uncontrolled government spending is probably giving some revenue stream to Facebook and Google and stuff like that. I just a hunch, just this sense, because they all have as their roots intelligence. The angel investors, all those tech companies were intelligence. They were various defense agencies. They spotted, the Wright brothers, the first money they made on their plane was to the French military. It's amazing. The French military bought the first plane from them. So, and a year later, they had a competition for flight. There were 23 entrants a year later. And then 7 years later, 7 years, they're using planes to fight battles in World War I. That's wealth creation in a bad sort of way. But I also talk about the idea that, I got an argument with an economist who said that World War II, famous guy, World War II pulled us out of the Depression. And I said, no, I don't think they did. We still had depleted consumption and stuff. There's a building up of need that wasn't being satisfied. He said, no, that's fiction. He says our GDP numbers grew 15% over World War II. But the GDP numbers measured the ability to produce bombs and drop them. So there's a thing that I'm going to write about called NDP, which is GDP minus depreciation. When a bomb blows up, the depreciation rate is pretty brisk. And when you send a battleship out there, even if it doesn't get sunk at the end of the war, it's probably going to get mothballed. Bad depreciation rate. So all that wealth in World War II that was generated wasn't wealth creation. That was military. Now, the wealth creation was we refined Henry Ford's assembly lines such that we could crank shit like there was no tomorrow. Assembly line technology went bananas during World War II, such that, they had plants that were putting out a bomber an hour. So when we came out of World War II, we knew how to crank shit, and that's wealth creation. So I'm writing about that. I'm writing about what's real wealth and what's fictional wealth. Warren Buffett creates no wealth, none.
Well, I really look forward to reading it. And, your point about, Facebook especially resonates. I mean, you look at marketing budgets and Facebook's revenue is entirely like 99 point something percent tied to advertising. Advertising budgets wax and wane with the economy. We haven't seen what Facebook can do in a down economic cycle. And will the ROI of the ad spend stand up on their own? Is it worthwhile on its own for me to place an ad on Facebook for my good or service? Am I going to get that back? I am highly, highly skeptical. I'm sure you are as well. I think our eyes are trained as we scroll through to, as soon as we see the signs of an advertisement, to ignore it.
We hate them too, right?
Hate them.
So we hate Facebook. Now, I know they're going to get that shit even if I don't have a Facebook page because they own so many subsidiary companies. There's no way, even if I don't have a Facebook app, my phone isn't feeding Facebook.
Yep. Well, this is great. I know you got to go. Dave, thank you so much for joining the podcast. Where can people read your work and follow you online?
Well, so I have a poorly marketed blog, poorly marketed meaning I post one a year. and it's called My Year in Review. And the reason I write it is because it seems a shame to let everything go by me and end up in a memory hole somewhere. So I keep notes. And at the end of the year, I have about 500 pages of links and quotes and funny statements and stats. And I pull it all together into about a 160-page document, which I go through the year and say, what the hell happened? I laugh. I get back. I go, oh, I forgot about that, right? So I write it up as partially for me and partially for, my narcissistic side. And then I do a lot on Twitter. I'm pretty obsessive, compulsive tweeter. And I can be found at David B. Collum, Collum, one word, at David B. Collum on Twitter. And I should spend far less time on Twitter or manage my time better. I'm not sure which. I have fun. I fight with people sometimes. I troll. I'll put out stuff that causes people to totally shit their pants. I asked the question, here's Wealth Christian. I asked the question the other day, if your job and your salary can be replaced with a government paycheck, what were you doing that was so important? Now, garbage collectors can't be replaced. The guys at the grocery store can't be replaced, but there's a lot of people who, if you pay them and they just go away, we've lost nothing. We discovered we don't need barbers, right? I can see you don't need one. I don't need one. Right. I have a pair of clippers that were basically 2 haircuts worth of clippers, and I will be cutting my own hair for many years. That the guy who made the clippers created wealth. The barber doesn't create a lot of wealth because you know why? A haircut depreciates fast. The depreciation rate of a haircut's really steep. So David B. Collum on Twitter and My Year in Review. If you're writing any of this finance internet shit, usually it'll probably come across your field of view somehow because it gets spread around quite a bit.
Yep, it does, and it is truly fantastic. I look forward to the next one. It is spicy. It is rated R in the financial cancel culture parlance. So look forward to reading it, Dave. Thanks to you again.
Yeah, I'm also probably going to get fired after this one, so that'll be fun. That'll make for a story for the next year.
Well, I will add one last thought, which is your podcast with Chris Irons of Quatharaven Research that was banned on Twitter. I have no higher ambition than to have a podcast censored for political reasons. I think that's about as cool as it gets. So congratulations.
We didn't hit it hard enough today. Why did we ban hate speech? Oh, I think we talked about shootings. Yeah, we got banned from YouTube. And I go, oh yeah. Tell me I wouldn't like to see Zuckerberg drive into a bridge abutment.
Yep, wrong think is no longer permitted. All right, well, thank you, David. Thank you to our audience for your time and attention. We'll be back next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.